Very good evening, viewers and my dear students. And this time I am going to discuss on a topic that is known as money market operations. The money market is a market for short-term financial assets that are close substitutes for money. The important feature of money market instrument is that it is liquid. This is market for borrowing and lending, short-term funds. Money market instruments are those instruments which have a maturity period of less than 1 year. Examples are treasury bills, certificate of deposits, commercial paper, etc. Now, I'm just going to discuss the features of the money market. The term short term means generally a period up to 1 year, and near substitutes to money is used to denote any financial asset which can be quickly converted into money. Low cost. It provides reasonable access to the users of short-term money to meet their requirements at realistic prices. But there are certain rigidities in the Indian money market. The money market is not free from certain rigidities which are hampering the growth of the market. The most important rigidities in the Indian money market are: point number one, markets not integrated. There is a high volatility. Players are restricted. Supply-based sources influence uses. Not many instruments. Players do not alternate between borrowing and lending. Then reserve requirements, lack of transparency, inefficient payment systems, interest rates not properly aligned, seasonal shortage of funds. Commercial transactions are mainly in cash, heavy stamp duty limiting use of exchange bills. Now, in the context of money market, I am just going to discuss call and notice money. The call money is a part of the money market. Day-to-day surplus funds, mostly of banks, are traded. Moreover, the call money market is most liquid of all short-term money market segments. The maturity period of call loans vary from 1 to 14 days. The money that is lent for 1 day in call money market is also known as overnight money. The interest paid on call loans are known as the call rates. The call rate is expected to freely reflect the day-to-day lack of funds. These rates vary from day to day and within the day, often from hour to hour. High rates indicate the tightness of liquidity in the financial system, while low rates indicate an easy liquidity position in the market. In India, call money is lent mainly to even out the short-term mismatches of assets and liabilities and to meet CRR requirements of banks. The short-term mismatches arise due to variation in maturities, that is, the deposits mobilized are deployed by the bank at a longer maturity to earn more returns, and duration of withdrawal of deposits by customers vary. Thus, the banks borrow from call money markets to meet short-term maturity mismatches. Moreover, the banks borrows from call money market to meet the cash reserve ratio, that is CRR requirements that they should maintain with RBI every fortnight and is compared as a percentage of net demand and time liabilities. In short, it is called NDTL. Now I am discussing Interbank Participation Certificate, that is IBPC. The IBPCs are short-term instruments to even out the short-term liquidity within the banking system. The primary objective is to provide some degree of flexibility in the credit portfolio of banks and to smoothen the consortium arrangements. The IBPC can be issued by scheduled commercial banks and can be subscribed to by any commercial bank. The IBPC is issued against an underlying advanced classified standard. During the currency of the participation, the aggregate amount of participation should be covered by the outstanding balance in account. The participation can be issued in two types, namely with and without risk to the lender. While the participation without risk can be issued for a period not exceeding 90 days, participation with risk can be issued for a period between 91 days and 180 days. The interest rate on IBPC is freely determined in the market. The certificates are neither transferable nor prematurely redeemable by the issuing bank. In the case of bank issuing IBPC with risk, the aggregate amount of participation would be reduced from the aggregate advance outstanding. The scheme is beneficial both to the issuing and participating banks. The issuing bank can secure funds against advances without actually diluting its asset mix. A bank having the highest loans to total asset ratio and liquidity bind can square the situation by issuing IBPCs. To the lender, it provides an opportunity to deploy the short-term surplus funds in a secured and profitable manner. Now I am going to discuss about money market mutual funds. In short, it is called MMMF. MMMF, MMMF pulls the resources from the investors and it invests them in a basket of money market instruments to generate the desired income. The government of India thought of introducing money market mutual funds on Indian financial canvas in 1992. An important part of financial market is money market. It is a market for short-term money. It plays a crucial role in maintaining the equilibrium between the short-term demand and supply of money. Such schemes invest in safe, highly liquid instruments included in commercial papers, certificates of deposits, and government securities. Accordingly, the money market mutual fund schemes generally provide high returns and highest safety to the ordinary investors. MMMF schemes are active players of the money market. They channelize the idle short funds, particularly of corporate world, to those who require such funds. This process helps those who have idle funds to earn some income without taking any risk and with surety that whenever they will need their funds, they will get generally in maximum 3 hours of time the same. Short term or emergency requirements of various firms are made by such mutual funds. Participation of such mutual funds provide a boost to money market and help in controlling the volatility. Now I'm coming to next item, that is called commercial paper. In short, it is called CP. A commercial paper is an unsecured money market instrument issued in the form of a promissory note. Since the CP represents an unsecured borrowing in the money market, the regulation of CP comes under the purview of the RBI, which issued guidelines in 1990 on the basis of the recommendations of the VWV working group. These guidelines were aimed at number one, enabling the highly rated corporate borrowers to diversify their sources of short-term borrowings. And number two, to provide an additional instrument to the short-term investors. It can be issued for maturities between 7 days and a maximum period of 1 year, up to 1 year from the date of issue. This can be issued in denominations of rupees 5 lakhs or multiples thereof. All eligible issuers are required to get the credit rating from credit rating agencies. Now, eligibility criteria for issuer of commercial paper. The company satisfying the following conditions are eligible to issue commercial paper. Number one, the tangible net worth of the company is rupees 5 crores or more as per audited balance sheet of the company. Number two, the fund-based working capital limit is not less than rupees 5 crores. Number three, the company is required to obtain the necessary credit rating from the rating agencies such as CRISIL, ICRA, etc. Number four, the issuers should ensure that the credit rating at the time of applying to RBI should not be more than 2 months old. Number five, the minimum current ratio should be 1.33:1 based on classification of current assets and liabilities. Number six, for public sector companies, there are no listing requirements, but for companies other than public sector, the same should be listed on one or more stock exchanges. And the last one, all issue expenses shall be borne by the company issuing commercial paper. So that is all about, and I'll be coming back with more videos. Thank you for viewing this. Thank you.